Alright everyone, if you've been following the AI gold rush, you've heard the name SoundHound. Their stock is a roller coaster, and their marketing says they're the future of voice. But today, we're putting away the brochures and opening the 10K. This is the 2025 Deep Analysis by HDIN Research. Is this a tech giant in the making, or just a very expensive M&A experiment? Let's peel back the layers. First, the wow factor. Look at this, 99% revenue growth. They basically doubled their business in 12 months, hitting nearly $170 million. That is insane growth. But wait, how did they do it? It's not just by selling more software. They've been on a shopping spree, buying up companies like Amelia and SYNQ3. They are grabbing land as fast as they can, and right now, 79% of their money is coming from subscriptions. That sounds like a solid SaaS business, right? Well, keep watching. Now here's where the suspense music kicks in. If you look at their bottom line, it looks like they're suddenly getting profitable. But don't pop the champagne yet. That profit is an accounting mirage. They had a $163 million gain simply because their stock price changed, which lowered the value of what they owe for their acquisitions. In reality, their operational loss is still over $23 million, and they burned through nearly $100 million in cold hard cash this year. They have a hole in their pocket the size of a crater, and they're filling it by selling more shares. To understand SoundHound, you have to see it as a three-legged stool. Leg 1, royalties from cars, steady, but not the star. Leg 2, the growth engine, subscriptions for AI agents in banks and restaurants. This is where the real action is. And leg 3, monetization. This is the future frontier, where your car might suggest a coffee and take a commission. It's tiny right now, less than 1%, but that's the Tesla-sized dream they are selling to investors. Let's talk about that growth engine. Subscription revenue didn't just grow, it exploded by 137%. This is the Amelia effect. By buying these companies, SoundHound transformed from a tech startup into a recurring revenue powerhouse. If you're an investor, this is the moat you're looking for. Sticky, monthly checks from big enterprises. Ever talked to a drive-thru and realized it wasn't a human? That's probably SoundHound. They are dominating the restaurant space because, let's face it, humans are expensive and hard to find right now. Their AI doesn't just take orders, it upsells you that extra side of fries without getting tired. It's a labor hedge, and for QSR chains, it's a no-brainer. Where is the money coming from? Mostly the Americas, thanks to those big acquisitions. But don't sleep on Asia and EMEA. They are seeing 50% plus growth there, primarily from car manufacturers. And a quick note on the data. Our report tracks high-performance licenses across the globe, including key tech hubs like Taiwan, China. Why do BMW and Hyundai choose SoundHound over, say, Google? It's about speech to meaning. Most AI listens, turns it into text, then tries to understand it. That's slow and prone to errors. SoundHound does it in one step. Plus, they are, quote, neutral. Google wants to own your car's data. SoundHound lets the car brand keep their soul. That's a massive competitive advantage. We're moving past chatbots into agentic AI. With the new Amelia 7, the AI isn't just answering your questions, it's doing things. It's logging into your bank to move money or resetting your IT password. It's the difference between a librarian who tells you where the book is and an assistant who goes and writes the book for you. But innovation isn't cheap. SoundHound spends 58% of every dollar they make on R&D. Imagine for every dollar you earn, you spend 60 cents just on thinking of new ideas. That's a high-stakes bet. They are building a tech moat, but they're paying a premium for the shovels. Here's the gray rhino, the risk everyone sees but no one wants to talk about. Their balance sheet is asset-heavy. They have $122 million in goodwill. In plain English, that's the extra they paid for companies they bought. If those companies don't perform, that value vanishes, and the stock takes a massive hit. It's a high-wire act with no safety net. Who's driving the bus? The founders. Thanks to a dual-class share structure, they have 46% of the voting power. You might own the stock, but they own the decisions. This provides stability, but with the internal control weaknesses mentioned in their audit, it also means there's very little room for shareholders to push back. In the arena, it's David versus Goliaths. On one side, you have big tech, Amazon and Google, who have all the money but want to steal your customers. On the other, niche players like Cerence. SoundHound sits in the Goldilocks zone, independent enough to trust, but big enough to actually deliver. Looking ahead to 2026, the goal is simple. stop the bleeding. They need to turn all those promises into operating cash flow. They are targeting a 50% gross margin. If they hit that, they become a legitimate SaaS giant. If they don't, they'll need to sell even more shares just to keep the lights on. So the verdict? SoundHound is a high-risk, high-reward transformation play. The bull case? They become the voice of the AI economy. The bear case? They run out of, quote, cash reserves before the integrations pay off. It's a classic Silicon Valley blitzscale. Are you a believer, or are you staying on the sidelines? If you want the full, unfiltered page deep dive on AI stocks and market trends, head over to HDINResearch.com. We don't just look at the headlines, we look at the ledgers. Contact our team at sales@HDINResearch.com for custom advisory. Don't forget to like, subscribe, and tell us in the comments. Is voice AI a trillion-dollar market or just hype? I'm with HDIN Research, and I'll see you in the next deep dive.